Hey, welcome to The Explainer. Today, we're going to jump right into a puzzle that trips up so many people, even the pros. How do you actually figure out what a company is worth? Well, the short answer is you can't just use the same ruler for every single industry. So let's figure out which tool works for which job. I mean, really think about this for a second. Why is a huge bank, with all these massive buildings and vaults, valued in a totally different way than a software company whose most valuable assets are the people who walk out the door every single evening? That's the big question we're going to crack today. And the secret, as you'll see, is all about understanding the unique story behind each sector. So here's our game plan. We're going to dive deep into 4 very different sectors. We're talking banking, IT, consumer goods, and gas. And we'll see the unique rules that make each one tick. Then, at the end, we'll pull it all together so you walk away with a brand new, much smarter valuation toolkit. Okay, let's get into our first case study, the world of banking. For these guys, it is all about assets. Physical assets, financial assets, you name it. Everything, and I mean everything, comes back to what's on their balance sheet. And this really gets to the core of how a bank actually works. See, a bank's most important assets aren't the fancy branch buildings. They're the loans they've given out. Those loans are what generate income. And because those loans have a pretty clear value on paper, the number one metric we look at is the price-to-book ratio, or PB. It's a direct comparison between the stock's price and the bank's on-paper asset value. And you can see this playing out right here. I mean, look at this incredible gap. You've got HDFC Bank trading at more than 4 times its book value, and then you have a giant like SBI trading for less than its book value. So what is going on here? Why such a massive difference? It's not just random market noise. That premium for HDFC, it's earned. They just consistently deliver a higher return on equity, or ROE, which is just a fancy way of saying they are much, much better at using their shareholders' money to make more money. You throw in better quality loans, they're more efficient, and they're growing faster, and suddenly it makes perfect sense why investors are willing to pay up for that kind of top-tier performance. So if banks are all about physical stuff, what about a sector where the real assets go home every night? Well, that brings us right to IT services. Here, we're going to completely shift our focus away from the balance sheet and onto people, and of course, the revenue those people bring in. For an IT company, book value is pretty much useless. Their value scales with, well, their people. The more skilled engineers you have, the more projects you can take on, which means more revenue. It's a direct line. And that's exactly why analysts use a totally different metric, the price-to-sales ratio, or P/S. It measures the company's price against its total sales. And just like we saw with the banks, you see a major premium for quality. A giant like TCS gets a price-to-sales ratio that's literally double what a typical mid-tier company gets. So again, you have to ask the question, why are investors willing to shell out so much more for every single dollar of revenue that TCS makes? Well, the answer really boils down to 2 things. They're stable and they're future-proof. TCS has way better profit margins and a hugely diverse list of clients, which makes them less risky. On top of that, more than half of their money comes from high-growth digital services. Their massive size just gives them advantages that the smaller guys can't hope to compete with. All right, let's make our third stop, fast-moving consumer goods, or FMCG. So far, we've looked at physical assets and we've looked at people. But for this sector, the valuation story is all about something you can't see or touch, the raw power of a brand. Take a look at this number, 65 times. Just let that sink in for a second. What on earth could possibly be worth 65 times its yearly profit? Well, that number is the price-to-earnings ratio, the PE ratio, that investors are happy to pay for a company like Hindustan Unilever. That is a gigantic premium. And that just begs the question, right? How can that possibly be justified? It all comes down to one word, predictability. When you have a portfolio of over 40 powerhouse brands and a distribution network that reaches 9 million outlets, your sales are incredibly reliable. Investors aren't just buying 1 year's profits. They're buying the promise of decades of predictable cash flow they know they can count on. Okay, for our final sector, let's look at something completely different again, gas distribution. These companies are basically regulated monopolies, where the value is literally locked deep in the ground. For these companies, the key metric is something called EV to EBITDA. Just think of enterprise value, or EV, as the total price to buy the whole company, and EBITDA as a rough measure of its cash flow. Now, this is where it gets kind of weird. Notice how the established player, IGL, has a lower multiple than the newer guys. Why? Because investors are pricing in the explosive growth they expect from the newcomers who are still busy building out their pipelines. So for a gas company, the valuation is really a mix of two super powerful forces. First, you've got the immense value of the infrastructure they already have. I mean, that network of pipes is almost impossible for a competitor to just build from scratch. And then you have their future growth, which is practically guaranteed thanks to exclusive rights and regulated profits. So, after this tour through 4 very different industries, what's the big lesson here? It's time to put it all together and build your new, much smarter valuation toolkit. Okay, this table pretty much sums it all up. Think of it as your valuation cheat sheet. For banking, you focus on price to book and the quality of their assets. For IT, it's all about price to sales and revenue growth. For consumer goods, price to earnings and brand power. And for gas, you're looking at EV to EBITDA and their infrastructure. The real key is learning to speak the unique language of each sector. And if you only take one thing away today, please let it be this. You have to compare companies within the same industry, not across them. And Apple is not a pipeline. Trying to value a bank with the same ruler you'd use for a tech company is just a recipe for making a huge mistake. Context is absolutely everything. So let me leave you with this final thought. The next time you look at a company, are you just going to ask, what's its price? Or are you going to dig a little deeper and ask, what's its story? Because understanding that story, that's the real key to unlocking smart valuation.